Hey guys, what's going on? Paul here and welcome back to another Cardano video. If you're new, make sure you hit the subscribe button and the notification bell so that you never miss an update, as what we do here is 100% Cardano content. We've also just crossed the 10,000 subscriber mark, which is a huge goal here on the channel. So it started less than 3 months ago, and to achieve that already is absolutely huge. It shows the growth of the Cardano community, and I really do appreciate all the support that we've been getting through likes, subscribes, comments on the videos, and shares to get the word out there. So today's video, I sit down with DC from Liqwid Finance and we go through what exactly Liqwid are doing. So in summary, Liqwid Finance are going to be one of the first projects to go live on the Cardano blockchain. So they're building a DeFi application. So sort of like, it's like Aave or Compound on the Ethereum network. They're building that type of infrastructure on Cardano. So it's very exciting to see projects like this coming out on the Cardano blockchain to see what they think of it. So I get into what Liqwid Finance is, how their token is going to work, why Cardano over Ethereum. So interesting stuff to get into. I do hope that you like it, and if anyone wants to really support the channel outside of liking and sharing these videos, obviously, then my own Cardano stake pool is under the ticker Paul, and all delegation to that really does help support the channel and videos like this. So thanks for watching, and now let's jump into it. And let me know down below anything we don't cover in this or we missed. Let me know down below and I will try and cover that in our next one. We're going to do a live stream with DC and maybe someone else from the team as well, where people can come in and get all of their questions asked. That will be in another few months when they have their token out on the live chain as well. So let's jump in. Hey guys, so welcome to the first interview on Cardano with Paul. Today we have DC from Liqwid Finance with us. Very welcome, DC. So very excited to go through this because Liqwid will be, as far as I know, one of the first operational projects on the Cardano blockchain. So it's great to get an insight into this and see what's actually going on, why projects are choosing the Cardano blockchain, and what's on offer out there in the community. So welcome, DC.
Thanks, Paul. Thanks for having me on. I'm excited. Great to be the first interviewee, so let's do it.
Yeah, we just crossed 10K subs today and first interview, so yeah, good times.
that's exciting, absolutely. And I mean, honestly, I've watched a couple of your shows. I think for anyone who's interested in Cardano trading and just talking about, real price talk from a trader's perspective, it's a great channel. We need more, kind of trader-focused channels in Cardano, so I'm all for it.
Thanks, man. I appreciate that. Yeah, we try to get a balance of obviously bring the fundamentals of the project in as well, and
of course.
So a lot of times they back up where the price is going. So what we will start off with today, I suppose, is what is Liqwid Finance and what are you guys doing? And work from there.
I thought we were going to talk about ADA price the whole time. Come on, man.
We'll save that for later if we have time.
Yeah. Sounds good. Yeah. So Liqwid Finance, we're building an open source liquidity protocol. In many ways, it looks very similar to Aave and Compound, at least in its first version on chain. It's going to allow users to bring their ADA and supply it as liquidity to earn interest beyond just the staking interest, right? The interest from actually lending it out to borrowers. Our actual main draw, though, is trying to create a platform that allows low-cost borrowing in stablecoin assets. We just understand that when you look at the entire DeFi landscape, it's pretty clear that traders want their debt denominated in stablecoins, not in these volatile cryptos. Yeah. For instance, when you look at the utilization rates of Ethereum, on Aave or Compound versus like DAI or even like US dollar Tether, it's not even close, right? Because everyone, who actually uses those protocols on the borrow side, who are really in many ways the true kind of value creators of all of these DeFi lending systems, they want their borrows denominated in a non-volatile asset. So yeah, we're gonna have a whole program to really incentivize the supply of ADA as well as the supply of AUSD, and it's kind of all tied into this initial rollout of Liqwid. And the V1 is coming. We're deep down in development right now. We have a full team of Solidity engineers, full stack front and back end devs. We're working with Tweak, who built Cardano's Plutus layer. We're working with Fire Labs. They're working a lot of ETH2 work. Near Protocols, another team that they actually work with. So we have a lot of domain knowledge and experience when it comes to not only Ethereum Solidity, But when it comes to testing and internal security audits of the protocol, before it ever reaches the light of mainnet. So these are definitely plans that we've had in place for some time, and Catalyst gave us the funds we needed to really start executing on this.
Yeah, you guys got funded in Catalyst Fund 2, was it?
Yes, yeah. So we received our initial funding, I want to say pretty much like half a month ago at this point. And even before then, we were pretty much entering full development sprints, just kind of our own founders paying it out of pocket and just putting in the time and grind to kind of get us there. But Catalyst has been awesome. The support of Cardano has been great. And beyond just the funding, I think the product support that you get from IOHK, being able to reach out to some, really good, deep resources within IOHK and ask them questions that, otherwise may have gone unanswered. It's really solid.
Yeah, I think they're really putting a lot in place trying to attract projects over. And Catalyst for me is one of the huge benefits of Cardano as well, in that any ADA holder can vote for what's going to be developed on chain and who deserves funding. So it's great to see it actually in practice, and hopefully over the next few months we're going to start to see the results of that. And you guys will probably be one of the first to bring back a product out of Catalyst anyway.
Yeah, well, we're hoping so at least, and a complete product at that. Like I think that many ways you can hack together a DApp in a weekend, but like if you're just putting together a rolling dice game, like are we really becoming more competitive in terms of like an ecosystem? So that's and that's just not a stab at any of these, gaming DApp projects. This is like truly talking strategic approaches here. When you look at Ethereum today and what's actually found market fit, demand, on-chain value being locked, and actually creation of value in terms of fees. None of those things are like dealing with like simple gaming and, turn-based strategy games. These are talking about complex DeFi systems that allow me to do derivatives. When you look at Mirror Protocol, I can long Tesla now, just having ETH and supply that and earn, whatever the absurd APY they're offering for that is. Like, those are the future of what's going to actually drive more users to these systems, not simple dice rolling, DApp games. I'm sorry, but like in Cardano, I think that we have to take that approach of strategy and saying, hey, there's so much out there that we can learn from in terms of if we're just good students of the game, look at what worked on Ethereum, what failed horrendously, and then just operate accordingly. So it's one of those things where I wish I could see and drive more strategy into this Catalyst process early on, but it is so much an iteration. It's so much like walking with the community and kind of growing together in many ways. But yeah, I definitely think that Liqwid is aiming to be a very complete ecosystem from day one. And that's just not something you see in DeFi Ethereum today even. And we're delivering it on a timeline that's, a fraction of what many of these VC-backed Ethereum protocols were able to deliver.
Yeah, just on like bringing out DeFi to me is a great way to start, because at the minute DeFi is the big buzzwords around, and I suppose at its core cryptocurrency is all about decentralized finance anyway, and bringing it back to being your own bank and everything like that. So for me, it's exciting to see the first DeFi project on Cardano and to see how it runs. And obviously you're going to come across bugs along the way. There's going to be things that have to be changed, but it's great to see something with such big potential out there. Like we look at what Aave and Compound and all of these, I suppose, projects out there are doing on Ethereum. To see something like that on Cardano will be great. And with Catalyst then as well, what you're saying, I think, it's changing all the time, and it's great to see that they're taking feedback on board and they're trying to improve that process all along the way. So it's like anything, needs iterations and needs improvement over time, but to have that type of funding in place is great, because other projects don't, or other blockchains, I suppose, don't have that incentive for projects to come in. And the fact that you were funding this yourselves before this to actually have something in place, that gives people who are voting on Catalyst a lot more, I suppose, confidence in putting more funding your way, that you guys are going to use it and use it properly. So
yeah, we competed in the Wyoming Hackathon pretty much at the same time as the start of Fund 2, and we basically built proof of concepts of our entire smart contract setup. Actually modeling a lot of it based on like the 5 main compound smart contracts an end user would use in our system. So if I want to, deposit and supply some assets, if I want to borrow, if I want to withdraw my deposit, if I want to pay back my borrow, all these actions that I can call as an end user from the, kind of in-app UI that Compound presents. We basically use the Marlowe tool actually, and some extensions in the Marlowe source code actually to create very similar proof of concept smart contracts. And yeah, it's actually really cool and powerful what Marlowe can really do. Even as a DSL, there's so many things and places that thing can go in terms of derivatives and complex financial products that you can build. So yeah, that was kind of the start of, a lot of what led through Fund 2, that Wyoming hackathon. And we were able to win that. And it was a great, moment for our team and just really kind of validating the idea and the concept early on.
Yeah. One of the questions I got was like comparing Aave Compound to yourselves, like what are the differences? And then there's BlockFi and there's Celsius. Obviously they're more centralized, but the ideas, there's similarities across all, isn't there? Or just for people who have no idea of what they can do with.
Right. Yeah, I would say the similarity is like what Alex Mashinsky said when he had, the recent interview with Charles. It's everybody needs yield. Like yield is the killer app of crypto. Like
that was a great interview actually. If anyone hasn't seen it, over on Crypto Crows, some really good stuff there with Charles and Alex. Sorry, go ahead.
No worries. Yeah, so it's true. Like yield to me is king, especially at this point. When you can get like more capital efficient yield too, and more just efficient ways to do borrow lending, that becomes an even better system. And what I mean by that is, and I have all the respect in the world for Stani and the Aave guys and Compound as well. They've done some great things.
But they're Ethereum, industry leaders, I suppose, in what they're doing. They're breaking.
You look at the price. There. Yeah, 100%. You look at the price of Aave right now, and you're like, wow, this is almost an indestructible force in terms of a blue chip Ethereum protocol. So DeFi protocol. So that's great to see for them, and well, congrats and deserved for them. But Ethereum as a chain is kind of where I have my real gripes, like it's just so inefficient and unscalable that when you actually try to use it to do really interesting things, like I'll take Avgachi, for instance, like the NFT game that they came out with, that lives on Matic network, that's not even on Ethereum, because to do that concept of integrating some like, high frequency transaction / NFT into a DeFi protocol is just really hard and difficult, right? And expensive on a blockchain like Ethereum. To do basic, entering and leaving compound markets is a $30, $40, sometimes $50 transaction fee, right? Like,
it's crazy.
And all the same. It's really bad. So the thing is, like, that margin begins to cut into your economic profit of your protocol, right? Like if I have a spread of, whatever, 25, 30%, which is probably the spread that Celsius and these other centralized kind of yield providers, Gemini, BlockFi take. If I have a spread of 30%, that's okay and fine if 20 to 30% is all I'm taking truly, and my margin is very little. But if I have a spread of 20 to 30% of my margin, and I'm actually paying out so much in just fees to the actual block producers of my system, whether it's Bitcoin, whether it's Ethereum, whatever it is, like realize that margin, that's your end user who's getting eaten away little by little, right? So those fees are actually coming out of like what the economic profit they would actually realize. So when you talk about these DeFi systems on Ethereum today, you have to realize like just building the equivalent protocol on Cardano is going to yield something that's maybe 10 to 100x more efficient, cost-wise, performance-wise, and just security guarantees that you're getting when you talk about using the KEVM versus using just the raw Ethereum virtual machine. So there's a lot that, we see and learn from the current protocols. Like I said, in many ways, we're building on the backs of giants. Stani and his team have done some amazing things, and we'll always give those guys credit and, reach out to them when we have questions and ask, interesting things that we see them doing. But yeah, I don't have that much desire to go down the path of ever doing anything on Ethereum at this point. I think that, they have a liquidity mode at this point. It's clear that that's a thing, but so does Cardano. It's clear that Cardano is building up its own liquidity mode and its own developer ecosystem, right? Through Catalyst, through this top-down process of IOHK, Emergo, and CF. So I do think that, in many ways, Cardano represents an Ethereum 3.0, and you can plug out Ethereum and put in any smart contract protocol you want. But I think that the move to like these proof of stake, green, programmable blockchains is actually already here. It's already happening right now in front of us. You look at the performance of Polkadot, Cardano, Solana, some of these up and coming, protocols. It's obvious that investors one exposure and realize the value in having, a programmable decentralized blockchain. I don't think the one that's going to, scale and win them all is going to be Ethereum. In many ways, I see like some of the protocols and the blockchain itself as a proof of concept of what programmable decentralized, applications can do in the future if given the ability to scale at a cost efficient rate. Okay. Like I'm not launching a protocol and making someone pay $50 to enter or leave the market. That's absurd. So I definitely think that like, and I'm sorry for my little Ethereum rants. I have to get it out because every VC, oh, it's true. I mean, every VC in the world we talk to is like, why aren't you building on Ethereum? Like, I'm like, come on, have you used Ethereum? Like, why I'm not building on Ethereum. Like, come on. And it's like, I get it. They don't understand the true technical capability that Cardano has and represents. They didn't see the vision when we did. So of course, to explain it to them is very kind of foreign and almost like a hard concept for them to grasp. But once you get through to some of them, and we have for a few of them, it makes all the sense in the world to them that, hey, you would launch on a protocol that's actually going to allow you to do so much more with so much less in terms of, cost on your end user, in terms of margin that you're going to actually take from the protocol's profit. So all these things.
Oh yeah, look, you're talking to a full-on Cardano community here, I suppose. So anyone watching this is going to be a Cardano fan, so they don't mind the rants against Ethereum. And that's lots of questions. That actually answers one of the big questions that I got feedback on was why Cardano over Ethereum, but it has to come down to scalability and fees. And like we look at 100%. Look at DeFi on Ethereum now. They do have some really good apps there and lots of good potential there, but it's unusable for the smaller guy. Like if you're doing anything under $1,000 on it, the fees are absolutely crazy. You could be paying 10% to put it in and then 10% to pull it out. And if you're not doing bigger money, it's pointless trying to get involved with it. So there's definitely, and even I don't think that there's any one blockchain is going to kill Ethereum either. I think long term, Ethereum will find their place. There will be certain apps that will work on it. When blockchains like Cardano or Zilliqa or any of these other ones that are out there, they take their market share, that will take some of the load off Ethereum. So they'll find their place in the market. Cardano will have their place. And this market is still so small that I think in the future, there's going to be huge potential for all of these to get a market share and enough market share to be successful on their own.
I agree with that. I didn't mean to like knock Ethereum to the point of saying this thing is
right now Ethereum is shit.
It's shit. They're going to come out with ETH2. They're going to try to do their scalability thing. And who knows if they still manage to have the liquidity locked on chain they have now, we might actually be talking about a scalable Ethereum in like 2026. I don't know. But like, we'll see. Like it's going to, I don't think that the bet on Ethereum scaling in ETH2 versus the bet on Cardano just scaling out the gate is such a different play and like risk reward play for me that the opportunity cost, of not, investing in Cardano and the plan that they were taking at IOHK versus, this research driven, academia turned into like deep Microsoft R&D approach versus the Ethereum guys, which is like, I get it. It's magic unicorns and you guys were the first to release smart contracts, but like nothing is sound or makes sense about the ETH2 system. Like when you look at Vitalik's post about where they are at with that rollout, what they're doing with their whole like fee burning system and how that's like supposed to be the new savior. Like a lot of what Ethereum is doing is just like on the fly kind of in many ways, like bespoke updates to a system that's like in mid-flight. So it's going to be really hard to like tell me that the liquidity moat that they have right now is going to remain there as more and more of these protocols, a la Cardano, Polkadot, Solana, you name it, start to really lock value on chain. So it'll be interesting to see.
Yeah, I think it's a great time for projects like Cardano coming out with their solutions that everyone's looking at Ethereum. They can't operate, they can't use it right now. So they're looking around the place. So with Ethereum with Cardano coming out with native assets now, the end of the month, and then smart contracts, it's a great time to start getting market share and getting projects over to it. And then I suppose once you guys go through it all and you have a working product, you will kind of be a showcase for other ERC20 tokens that are out there. Then when they look at the likes of the ERC20 converter that will be there, and you guys will be able to show them like, this is how smooth things can run on Cardano, and this is the fee structure, the way that the whole thing works. I think that will be a huge selling point for attracting new people over to the Cardano blockchain. Like, we have a big community now. What we need is developers now, and we need actual applications on the blockchain. And I do think that is coming this year.
100%. It's coming in the next 3 months. And I'm confidently saying that with like just the speed that we're executing at right now with development. And, you know, we're looking to always increase that and push the pace. You know, I'm a competitor by nature. So I definitely think I was an athlete and I played, college football. And I definitely always had that competitor spirit in me to, you know, be the best and deliver something class. But I understand that like there's a whole like protocol security and auditing that has to come with these systems. So it's always like, how do you push the pace, but also how do you, you know, implement something that's functional and secure? And in many ways, I implement software in my day job. This project Liqwid is like almost a culmination of everything I've learned, you know, as a consultant working on, you know, software projects with data and developer guys and saying, hey, this is the safe, efficient, you know, functional way to actually deliver a project that's on time and on budget. It can be done, you know, with the right project management, you know, tools and resources. It just takes structure. It just takes someone who actually really understands what the different development phases need to look like and how you need to progress through them for successful implementation. We're doing exactly that with Liqwid. We started last summer and we feel confidently that, you know, in the next 3 months, we're going to deploy our V1 system.
Yeah, it's
anyone
really,
in Cardano can come
this is
in
the time when it comes together.
Absolutely. Yeah, this is the time.
Just, I suppose other popular questions then was on the Liqwid token, people asking how can they get it. And I know that the native assets are now gone live on the testnet. I've seen you had a post out, you've created it on the testnet, have you?
Yes, yeah, we have. Yeah. So we were actually the second token to mint on the testnet. There was the guys, the Steak Nuts guys beat us by 4 blocks. They minted their one nut coin. I was really trying to get that first one, but no, they were really quick. Good for them though. Those are great guys, and they do some really good work for Cardano and this ecosystem. But yeah, we're excited to actually, you know, one, validate everything that they've been working on at IOHK with multi-assets. And it was as simple as, you know, creating a transaction on the chain, which means that, you know, Cardano is automatically going to become the almost default chain to not only like mint multi-assets, but security tokens, NFTs, you know, assets that have to carry, you know, ID or be unique one-to-one, right? So these things that are like kind of even like unique use cases that extend way beyond ERC20, kind of like standard Ethereum tokens. I think Cardano is going to become just the default chain for minting these type of assets in the future, with how simple and easy it's going to be. And if they ever build like a bespoke DSL layer on top of that, it's going to become even easier for the everyday, you know, non-developer to do that themselves.
Yeah, and just for people who are familiar with ERC20 tokens, Cardano is doing them in a different way. We won't get into the specifics on it, but with Cardano, they're actually, they can inherit all of the functionality that the actual ADA token has, or ADA coin has. So there's a lot of scope there for expanding and what you can utilize on the blockchain using the native asset on Cardano over the ERC20 token. I'll do another video talking more deeply on that, but just on a high level. And then I suppose actually people getting the token. So the 22nd of February is the tentative date for native assets going live. We won't hold that as the hard date or anything, but after that, can people get tokens then, or do we wait till smart contracts come along, which again, we don't have a final date on yet, but should follow in the next few months?
So we're expecting smart contracts to follow pretty quickly after. And we actually hope that the KEVM is going to launch before Goguen officially, so through this main chain. So we're hoping to launch, you know, definitively within the next 3 months. So at the same time as launch is the first time anyone will be able to gain tokens, including our core team. Like, we're going to mint these tokens on, you know, the 22nd when the hard fork occurs, happens, and we're just going to put them in a ledger device and they're going to be sitting there, right? The whole point of launching with a fair token launch event, we came out with a recent article that explains our yield farming and liquidity provider incentive program. It's basically actually saying to do 2 things at once: distribute the governance token and incentivize liquidity onto the protocol at the same time. You have to have these like fair token launch events. When you look at the, you know, rise of the kind of new wave of DeFi protocols, it's all been, you know, fair token launches. It's all been minimal insider VCs who like are diluting the token early on and actually allowing the community to come in, you know, earn higher than normal APYs to provide the liquidity, whether it's ETH, whether it's DAI, whatever that specific token that protocol is trying to incentivize the most. you basically create, very high yields through the governance token around that, and then you incentivize the locking of capital in your protocol. And that's exactly what we're going to do with Liqwid. We're not going to actually start any type of distribution before we can start the actual supplying of capital and, the earning of interest on the protocol. So the same time that the V1 ships, you'll be able to use our product, and in just using the service itself, you will yield LQ from just the user distribution system. If you also wanted to take, the tokens that you mint upon supplying your ADA or AGUSD, you can also lock those up in a yield farming staking contract and yield additional LQ yields on top of that, right? So there's many different ways that users will be earning LQ in the system, essentially. There's also a dividend method that we're going to shortly implement after that, and it's going to be pretty much all actually automated within the system. And actually that alone is going to be another incentive to hold LQ and not just farm it like you see with Compound, where you basically go in, you farm your comp, and you sell it immediately to kind of lock in the price. So there actually are going to be some incentives and disincentives to kind of selling your LQ, where actual LQ holders will definitely be yielding more of the protocol's economic profit than those who don't hold any LQ. Yep.
Okay.
And it's also a governance token. So there's voting, there's liquid democracy, there's the delegation of votes to users in the system. So its actually main purpose is an update mechanism and a coordinating mechanism for the entire protocol. So we're saying, as a founding team, we want to step aside at V1 and let you guys as the community run with it. Like, whether that means a new governance framework, whether that means, whatever the analysis frameworks that we come up with to value new tokens that we want to introduce on the protocol, the changing of parameters, anything that affects the actual smart contracts that are on chain, or is trying to, raise funds or something similar to Catalyst to do an integration with Liqwid, or to build a product or maybe a marketing campaign around Liqwid. There's an entire Liqwid DAO treasury, and the funds within it can be dispersed by any, community member who has a good enough proposal that gets voted on, funded, and, has enough support behind it, basically.
Okay. Yeah, actually that document, I must get that, and I'll put that below the video as well in the description, just for anyone who wants to dig more into the actual distribution. But I suppose on a high level, for people who are looking for the straightforward answer of how they can get it, they'll have to provide liquidity put in liquidity for the loans or anything like that, and that's how they will earn liquid and interest then.
Right. So you have to supply your ADA, you have to supply your AGUS dollar. Those are the two tokens that we're going to have at the launch of the protocol.
Yeah.
In doing so, you're not actually necessarily opening a loan. You're just actually supplying to the liquidity pool itself. So the ADA market, the AGUSD market. Other users can come collateralize a position with AGUSD or ADA and then take out a loan from the pooled funds. And then once they take out that loan, basically, the pooled amounts is actually the interest rate that's being earned on top of staking. So if it's 10% because you have a medium utilization rate, then you're earning your base 5% staking plus 5% on top of that because you're actually having outstanding loans in the system in the protocol. If it's a very low utilization rate and not many folks are like taking out loans in ADA, most of your interest or your rewards are just going to come from that base staking rate, right? So that's essentially the protocol.
So just on that, actually, people were asking, can they earn staking reward? Can they leave their funds in a staking pool and earn that? And then I suppose double dip in a sense. They're getting interest on Liqwid and they're getting staking. How does that work together? Or once people take out a loan through or borrow through Liqwid, do the coins then get taken out of the stake pool and given to the borrower?
That's exactly what happens. And I guess we just need to explain this way more in detail. So I'll try to give it a shot here at like an LE5 level. You can't lend out coins and have them in a staking pool at the same time. It's physically impossible, okay? You also cannot have tokens in your Daedalus wallet and be supplying them to a smart contract at the same time. Physically impossible, okay? Yeah. Because when you send tokens from your Daedalus or your Roy wallet to a smart contract, by definition, it is leaving the pool that you're currently staking with and entering a smart contract that becomes the custodian of that, right? You can check the logic of that smart contract. This is all open source code. You can verify it yourself before you use it. But these are fundamentally different things when you're saying I have ADA sitting in my Daedalus wallet staking versus I have ADA that's now deposited into a smart contract. Now, when I do that deposit into the Liquid ADA market, we are working on a functionality that will, in the in-app UI, present a transaction body to the end user and allow them to, with their stake key, sign a transaction that gives the right of stake management to the actual smart contract. There's several notions of this that are live on Ethereum for E2 staking. Block staking is an example. And we're basically trying to mimic the functionality of a block staking, which is like a decentralized stake key management protocol, essentially. And you can do these things using some on-chain, off-chain magic, okay? The implementation details we have around this feature are not finalized by any means, okay? We are working very closely with the IOHK devs to fully scope this out, to fully decompose this concept and ensure that all of our implementation details are secure, functional, and cost-effective, okay? All those things have to be in place for this solution to work at scale, okay? So it's a very kind of straightforward process when you actually understand what's happening here. You are basically allowing your staked ADA that is not being borrowed, that's just sitting in the liquidity pool, to also be sitting in a staking pool. When I come along as a trader who wants to open out a loan in ADA, I am pulling ADA out of the liquidity pool and staking pool that it's in and borrowing that amount. It is coming into my wallet. It is leaving the staking pool. These are not happening at the same time. It's impossible, okay? So that's number one, okay? And then the second point of this is, like, the reason that this is functional and you can actually do this is because there is no lockup period with ADA staking, okay? You can enter and leave a staking pool on demand. And by signing a transaction body, once you come to deposit into the ADA market, functionally, you're not even leaving staking because you're just going to, restake with the initial pool that you had. And actually, there shouldn't even be a loss of stake rewards technically, right? Because
because you switch straight over then. Yeah.
Right.
And even when it's borrowed then and it switches over to the borrower taking it, there shouldn't be a loss there either because you start earning the interest on the funds that are borrowed then that will replace the interest you're earning on staking rewards.
And it should be, it will always be higher, right? Because to keep this in mind, like you want your ADA to potentially be, loaned out because you're earning a higher prevailing interest rate, like you just said. Yeah. And the thing is this, like with ADA's risk-free rate of staking on Cardano, so meaning anyone can always earn 5 to 6% APY just from staking out their ADA in a performing pool, right? These pools are all commoditized services, as Umed likes to put it. And he's right. Meaning, like, you guys are all essentially, I'm not sure, you're a stake pool operator.
I have a pool as well. So.
Oh, you do? Oh, nice. I just assumed. Great. I love it.
Stake to pool, guys.
yeah. There you go. Absolutely. So all of these pools are just providing a very commodity-like service. You guys are essentially doing the same thing. There's small improvements and performance gains to be had, but essentially the software works and the protocol works in a way that essentially everyone who has a certain threshold of ADA is always going to make
every pool. It's a common question I get as well is if I go to this pool, will I get more? Will I get more in this one? And it all comes down to the lottery, the protocol lottery that decides who gets blocks in certain epochs. So in general, most pools will average out to that 5%, slightly above or below. And there'll be good epochs and bad epochs, but on average, they generally all come in around the same. Slight differences, but not a whole lot.
And when you look at pools over like 100 blocks made, you start to see the trend. It actually really does kind of even out and becomes like this average of like 5 to 6%, sometimes higher, sometimes lower, right around that number. But yes, I do agree. It's all based on that VRF lottery. It's a good thing some epochs and it's terrible to use some others, but it's how the system works. But so what I'm saying is, to get back to my example, like because you always have that risk-free rate of staking in Cardano, you have to imagine and expect that every time the borrow rate is set, it's going to be at minimum 5 to 6%, right? Because how could you open a loan in something, and have a prevailing borrow rate that's even less than the prevailing risk-free staking rate from just holding Cardano in your dataless wallet. So that's something that I think folks who are actually depositing their ADA should consider. Like, this is actually a way to earn yield on top of just the risk-free rate that Cardano has. We're actually in many ways just capturing the base time value of money that Cardano has and then putting that itself into this money market protocol that allows other traders and users to borrow ADA and actually pay a higher prevailing interest rate. So yeah, I hope that clears up that question. I'm always asked that.
No, I think it does. Yeah,
Twitter,
I had a fair understanding of it myself, but that question was asked a lot when I mentioned coming on to talk to you guys. So that should, and I might even take that segment out into a separate video and put it out on Twitter or something that can be shared out.
I was going to say, happy to come back on when we have some final, hard implementation details around that and kind of share that with the community.
We might do a live stream at that stage where people can ask questions on the fly then as well at that stage. So,
totally.
So I suppose I'll just look down through the questions, see what we haven't covered. A lot were around the LQ token, how they can get them, how people can earn with it. So BlockFi and Celsius, how you're different to them. I suppose they're centralized, you're decentralized is the high level.
Sure. Yeah, exactly. That's the highest level, right? But I mean, at a lower level, like you really have to think about the kind of architecture from the centralized custodian player to a completely decentralized system like, Aave or Compound or Liqwid, right? Like these are fundamentally very different things that have extremely different risk profiles that a user has to kind of like weigh for themselves and measure like, okay, I'm not going to like, in many ways, like if my grandparents were entering crypto, I'd probably just say, go with BlockFi, go with Celsius. It's way easier for you guys to manage and use. Yeah. And the risk for them with only, $100 to $1,000, it's very low, the centralization risk. Okay. When you're talking about someone who one is younger, holds a lot more tokens, wants to have more direct control of them and doesn't actually want to give up the possession and ownership of their tokens to a centralized entity, right? Like that becomes a totally different risk play, right? And then when you talk about the ability to earn the governance token from the launch of the protocol, the ability to just give up possession, but not ownership of the tokens, and from a tax implications, like there's many reasons why you would actually just want to supply to a decentralized protocol that is like a custodian of a smart contract instead of a centralized entity that can basically do some rehypothecation and very kind of like neo-banking like things with your assets without you even really knowing it. With our system, every single transaction is on-chain, verifiable. The code is open source. You can see exactly what these smart contracts are doing with your funds, how they're being utilized. You just don't get that level of detailed transparency, trustlessness when you go the centralized route. And, maybe their yields are better. I actually see some of the yields in Celsius. And I'm like, wow, this is like, I don't even know how they produce some of those yields. But again, you're talking about a centralized custodian that has just way more tools in their basket in terms of traders, miners, producers who can directly take out loans and borrow from them. But still, how is that any different than just a neobank today, right? You're not really getting away from the centralized, single party failure system. You're not really getting away into a more trustless-based system. I mean, in my opinion, like, okay, these are like PayPal 3.0s. These are like, neobanks that allowed me to do similar things with my crypto, but this isn't a decentralized system. I'm not trusting a smart contract. Yeah. I'm trusting a dev at Celsius or BlockFi to not, rug pull.
Yeah, and that's the big reason that a lot of us wouldn't put your full crypto holdings into something like that, because there is the risk reward ratio, and I suppose there will be the equivalent with Liqwid as well when it's live. There is that. There's the stability of just earning your staking rewards, but for people who want to take a little bit more risk and earn more, you can put it into the smart contract as well. And now when I say risk, I'm meaning just on the contracts and all. There's always risk in anything that you don't have sitting in your own wallet. There's always increased risk, but
100%.
Obviously you guys will be doing a lot of your testing and getting everything audited before it goes live, so that reduces the risk levels. But just to put that out as well.
Yeah, and we can talk about that. There's three kind of main risks I think about with these protocols. Like you said, there's protocol security, which is like, in many ways you mitigate that when you do smart contract audits, protocol audits, just in really solid and thorough internal QA and testing across the board. We'll mitigate protocol security risk to as much as the degree you possibly can, right? The second is like governance risk, actually. So who decides, who upgrades the network? How does that mechanism function? How trustless is that process, right? And I think that, some protocols, Compound, they've got something that I think is going to work in the future as long as, the VCs kind of let it actually function. When you look at the recent Compound exploit and what happened, actually the aftermath with governance, it becomes very clear why, like, it's just not a great system to have so many insider investors and VCs who control so much of the governance token are able to easily sway decisions that are, you know, for them to gain the most and for the end user who is actually affected in the exploit to basically reap nothing. I think that was a really unfair move from the VCs at Compound, and I never want to create a system where a bunch of early VCs have ownership of the token and can sway decisions like that affect millions of dollars and people. So that's not going to happen in our system, you know, ever. And that's from the launch of the protocol. Not having that type of early insider VC removes a lot of the governance risk that you see in like a Compound today, right? I think that the third is like market risk, right? And you talk about like the price volatility of certain assets that you're going to list, the stability of using certain stable coins that actually have, you know, algorithmic pegs instead of, you know, Tether, where the questioning of the actual fiat backing is really out there. And that's why you see it lose its peg so aggressively at times and trade at like, you know, low mid 90s. I think that those things all factor into the market risk of the protocol. And you have to, you know, really analyze and kind of weigh each asset that you're allowing, how you're going to set up the parameters around that. There's like, you know, risk mitigation and insurance layers within the system in terms of the collateral factors, in terms of the actual rates of the reserves for each market that you set. And you actually use those as like an insurance layer to always have the ability to backstop your suppliers in that worst case scenario and example. So that market risk presents itself, you know, across the protocol. And I think you have to just build parameters around it accordingly once you kind of weigh and assess how real some of these market risks are for different assets that you're supporting.
Yeah, I suppose that the other one as well, there was another question on collateral liquidations. So what happens if people, so this will be people who are borrowing and they've put up collateral against. So for anyone who's never done this before, when you're taking a loan out from platforms like this, normally you put up collateral and then you can take out a certain amount as well. So for people taking out loans, how is the liquidation status managed? And so basically for anyone else, that would be where the price of the coin you've put in as collateral, if the price of that drops suddenly, your loan could potentially get liquidated and your collateral is taken, or how is that balanced? I suppose it's
and also
it's a tough one.
If the price of the asset that you borrowed goes up in value a lot too, the same way, you know, your collateral can drop. If your borrowed asset goes
that's
up
the flip
too fast,
side of it too.
Yeah, right. You're in the same position, right? And that's why, you know, not many borrowers and traders want to open loans in Ethereum, ETH, right? Because it's like, okay, if I open a loan in ETH, I'm essentially going short ETH, right? And I'm saying I expect the price of ETH to either go down, right? Or if the price of ETH does go up, I'm risking, you know, getting liquidated pretty quickly, right? Depending on how much of a cushion I've given myself in terms of how much I've collateralized versus how much of that collateral limit I've opened the loan in, right? And there's ways to kind of allow users to safely open loans in your system. You can like set the kind of default amount that a user opens a loan in to only 80% of the actual limit that they can open a loan in based on how much collateral they've put up. And that in many ways gives you a 20% cushion. You could say that, you know, for some of these volatile assets, 20% is not enough. You know, you can make that decision, and that's like a personal choice that every trader who opens up a loan is going to have to assess themselves, right? But I think that doing things like that, making the default kind of a 20% margin is a good thing to have. But let's talk about the actual liquidation mechanism. And this is another thing that not fully finalized in the implementation detail, but I think we're understanding enough of what we're doing that we can, you know, really talk at depth about it. So essentially there's a protocol in Ethereum, it's called Atomica. And what they do is actually pooled liquidations, right? So in many ways, it's almost like you created a compound money market that's only purpose is to do liquidations. And, you know, Compound doesn't do this. They have a liquidation contract call that anyone, you know, end user can call. You can basically pay the underwater loans collateral amount and then swap those assets essentially. And there's a liquidation bonus that's like involved in that incentivizes these liquidators to call the liquidate contract in Compound. But in our system, we're actually going to do pooled liquidations more similar to Atomica. So what's going to happen is users who say they don't want to, you know, enter the ADA money market and have their ADA potentially loaned out, say they only want to enter this liquidation pool that has their ADA, same thing, you know, being staked, but actually when there's liquidations, so underwater loans in the system, you can automate the process of directly using the ADA that's sitting in this liquidation pool to be used to actually purchase that user's collateral. And you can actually build atomic DEX into the liquidation pool and have the swapping of assets done almost automatically so that you repay that initial borrow market that the user has, taken assets from and been, basically liquidated from. So you can actually have a very contained liquidation process. And that's what I mean by like just a more complete ecosystem. Like we're not relying on external liquidators in our system. We're saying that by setting up a liquidation bonus of 10 to 12% and allowing ADA holders to just come provide their liquidity to this, basically liquidation, almost like LP pool, because you also are going to take Uniswap type 0.3% trades on all the fees that this atomic DEX has to process essentially. So you're saying, okay, now this is a totally different risk profile. I'm no longer, borrow lending my ADA in a money market. I'm now actually in a liquidation pool that's also acting as a DEX kind of LP service for the entire protocol. So you can basically earn a different, rate of return that's almost guaranteed with liquidation because the bonus will be fixed at 12% or probably across the entire market. So it's a different system, and it's an extension of Compound. Sorry to cut you off.
That's very interesting. I hadn't actually thought of that side of it at all, but it's great to hear of solutions out there. Something like that can be good for everyone in it. So it stops the person getting liquidated. It also helps others earn more on it, because if it's what we see in a lot of the markets is there's crashes and then there's recoveries straight away. But what this does on some, I suppose, hard liquidation systems is everything gets liquidated, and then when the person comes back, they see the price shot up again. If they had to get in time, they could have added more collateral. So if there's an automated system that allows them to do that, then I think that will save a lot of people getting wrecked on these types of things. So
so I want to just clarify one point. Like users are still going to like have to manage their positions, right? Like you can still get liquidated. What we're saying is we no longer rely on the incentives to say external liquidators who are not in our system, please call this contract function and we'll give you 8% or, whatever the liquidation bonus and Compound is to pay off this underwater loan, right? We're now saying ADA liquidity providers who also want to earn, these 0.3% trades and all the atomic DEX trades, you guys can provide your ADA, get some, QLP tokens, essentially the same thing you would in Uniswap. And you're now in just a liquidation pool. So the same way we have money markets that are just like liquidity pools, essentially, we're going to have a liquidation pool that's saying the logic of liquidating is going to be automated and only used by the funds that are sitting in this pool, so that these users directly accrue that 12% bonus, and even more because they're going to accrue the fees from swapping all these assets as well. So it's definitely still like you're always going to have liquidations, and you need it because it protects your protocol from like the real default risk that exists when you have too many loans that are not being paid off in time. And you saw that on Black Thursday with Compound. There simply wasn't enough incentives for the liquidators, and that's for many reasons, right? It's Ethereum doesn't scale. Ethereum's meme pool is a scary place where you can get easily front run by bots or traders or miners. So there's many reasons why liquidation on Ethereum is like a very inefficient process. But let's just say that Atomica and the solutions they're building on the pool liquidity side are in many ways the solution to a lot of that, because you're saying in the same way that you can AMM, you can pool funds on Aave or Compound, you can just pool liquidation funds in the same way and liquidate at scale when you need to. Because for a lot of people who want to call the liquidation contract and earn that, it's like a trading strategy, right? You can earn basically 8 whatever on Compound today, 12% like we'll have in our system. By just having the funds required to liquidate this at a time. And keep in mind, like most times the collateral value has dropped a lot, or, the borrowed asset has gone up a lot. So you're buying at a discount already, and then you have this liquidation bonus on top of that. That's essentially how the system is going to work. But more details on that to come very soon.
Sounds good. Okay, I think we have about 5 minutes left, so I'm going to fly through some of the questions.
Sure.
Liquid token, will it be stored in Daedalus, or how will that be stored? Will it be Yoroi, Daedalus?
All of them. Daedalus, Yoroi, yes. Every Cardano wallet essentially will be able to store LQ. It's a native token on Cardano, so it'll be treated the same way as ADA. That's kind of what we were talking about.
And then exchange-wise, will you guys be listing it on exchanges? Will there be Cardano DEXs coming down the line?
I mean, we would love to see some Cardano DEXs. We've reached out to the Bondly guys. I do believe Emergo is working on some like deep secret decks that they're hopefully going to come out with pretty soon. I've also
that would be really awesome to see on it.
Yeah, no, it would be awesome. I've talked to guys at Vacuum Labs who were thinking they built Adalite and they were thinking of building a Uniswap-like DEX on Cardano. So I do think that one of the development firms or the 3 OG entities is going to build a DEX at some point pre-Goguen. We'll definitely look to get listed there first, and then go from there. We're working with a securities attorney, so if any centralized exchanges want to list us, we'll have all the terms and disclosures and Howey statements that say we're just a utility token and nothing else, so that we can be listed on these exchanges. So yeah, that process is starting to ramp up, definitely.
As I'm scrolling through the questions on the other page here, that was another one about regulation, how this type of process is regulated. But once you guys have that in mind, obviously, to have everything in place for the long term is good.
Yeah, and we're not a security, we're not selling tokens. There's no ICO or token sale. This is like a true governance token, utility token platform.
This is the advantage of a fair launch, is that
exactly. This
you're
is
not
why you do
classed
fair
as a security then.
Right. Totally.
I think that's a lot of it. Those other ones around the ERC20 converter, and how do you see other projects coming from Ethereum over to Cardano? If you give it a minute on that, maybe just what you see.
Yeah,
why
that's a good question.
Projects? We've covered a lot of it, I suppose, but just if you see others coming over.
I mean, I see AGI. I see them trying to do some things. They'll probably use the ERC20 converter and migrate their token over. Again, I think this all comes down to use cases that exist today. I don't see, to be honest, many of the DeFi protocols coming over to Cardano, and it's not that Cardano has any issues. It's that there's a liquidity moat on Ethereum already today. So it's you're not going to redo all of your infrastructure and kind of rebuild your system essentially with this migration if you already have $1 billion locked on your protocol today, right? You have no incentive to really do that. And people thinking that Catalyst Funds is going to be able to incentivize entire protocol teams to move, that's not going to happen, because they have so much more in terms of risk during that migration process compared to what they're going to get out of it, compared to their current situation. That's a huge risk reward strategy almost play that all these teams have to make. I understand why Singularity is doing it. Cardano is so much more of a functional chain to do AI, to do these type of systems and protocols. So that makes total sense. And I think there'll be more. There'll be plenty of teams that are kind of mid-major, kind of they've done some interesting things on Ethereum, but they maybe haven't gotten true market fit, and they'll try to bring their migration and users over to Cardano, and that's great.
Yeah, I think any of the established DeFi projects, absolutely, they have too much to risk to try and move. It's more projects that just have an ERC20 token that need a better blockchain, a more efficient one to move over to, or ones that are looking, they might have their token and project already that they can move easily to Cardano, because it's just basically swapping out a token rather than swapping out the whole protocol. Even though we do have the ERC20 and you can develop in Solidity on Cardano and everything like that, but I think when you're talking big money for DeFi projects, there's a lot more to consider rather than just compatibility on the Cardano side.
Right, just compatibility on the token side. That alone won't do it. I totally agree. Hey, I'm sorry, I gotta.
No, that's anything else you want to throw in there, and we will wrap it up.
I wish I could go for an hour more. Honestly, this has been awesome. No, I mean, Paul, you've been great, and I think that the questions from the community are awesome. I would love to come back on, do a live stream when
we definitely will.
We're closer to launch, when we have a few more things kind of finalized on the implementation side, and we can kind of really give some hard answers to the community and a lot of these things, how it's going to work to the technical detail level.
Yeah,
and we'll bring our product guy on, we'll bring Florian on, we'll have just a real kind of more technical discussion on everything.
Yeah, I think we can definitely do that, because you guys have a fund in again for the upcoming Catalyst vote as well. So anyone who's looking for projects to vote for on Catalyst, hopefully this will have given an insight into what Liqwid are doing, and consider giving them your support as well.
Please, vote for Liqwid.
Thanks very much for coming on today, man. I really appreciate it. Giving me a great insight. I hope it does that for the viewers as well. So we will definitely hook up again.
Absolutely. Thanks, Paul. I appreciate
your time, man. Thank you.
Take care. Have a good one.